Welcome. Depreciation can be intimidating. After all, it's complicated and often confusing. But if you make any long-term purchases, such as furniture or computers, or you use your home for care, you need to understand depreciation and how it can impact your childcare business. In this video, we'll review the basics of depreciation and how it works. The information contained here has been prepared by Civitas Strategies Early Start and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies Early Start team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute, an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited. Please note that this presentation is designed to help you understand the basics of depreciation, how it works, and when you need to prepare for higher taxes. However, this presentation should not be considered tax advice. Please consult with your tax preparer or accounting professional for specific guidance and information regarding depreciation for your business. As we move through this presentation, you will learn about the definition and importance of depreciation, how to calculate and expense it, and how rules and record keeping can help you deduct your depreciation faster. Whenever you make a purchase that has a lifespan of more than 1 year, the Internal Revenue Service requires that it be depreciated. That means you write off the cost on your taxes over time, rather than just during the year when you purchase it. Depreciation can apply to many things in your business, including furniture, dishwashers and other appliances, computers, buildings and renovations, and vehicles. Let's dig into what this means a little deeper and learn how it can help you as a business owner. To determine if a purchase is subject to depreciation, you need to ask several important things. These include: 1. Is the item ordinary and necessary for your business? That is, do you need this to run your business? If the item is not ordinary and necessary for your business, then it is a personal expense. If it is ordinary and necessary, then move to the next question. Question 2. Can the item last more than 1 year? If the item cannot last more than 1 year, then treat it as a typical business expense. For example, paper towels will likely be used up in a year, so they would not be eligible. However, a desk or a newly installed deck for a family childcare provider would be eligible, as these items will last more than 1 year. If the item can last more than a year, then move to question 3. 3. Is the value more than $2,500? Any item, even one that could last for years, that has a value of less than $2,500 is considered a safe harbor where they can be expensed in 1 year and will not be subject to depreciation. Keep in mind that this is a per item limit. For example, if you purchased 50 chairs for $100 each, even though the total bill was $5,000, each chair is less than $2,500, so depreciation will not need to be applied. Anything less than $2,500 is treated as a typical business expense. If the value is more than $2,500, then move on to the final question. Question 4. Is this a repair or maintenance cost? Cost to repair or maintain items for your business, including your home for family childcare providers, can be expensed in 1 year and will not be subject to depreciation. For example, let's say you have your roof shingles repaired and it costs $3,500. As a repair, you would still be able to deduct it in 1 year and depreciation will not be applied. If it is not a repair or maintenance cost, you will need to depreciate the item. If it is a repair or maintenance cost, report it as an expense on your tax return. There are 2 other considerations in determining if an item is subject to depreciation, both related to family childcare providers. First, if an item is exclusively used for business, 100% of the depreciation can be applied to your business. However, if an item is mixed with personal and business use, like a new cooling system, for example, you will need to determine the business use and deductible amount using the time-space calculation. Second, family childcare providers can deduct the depreciation on their homes. Home depreciation is based on the value of the home and any renovations minus the value of the land. The best way to determine the land value is through your local assessor's office and then subtract the amount from your total value. For example, if you purchased your home for $400,000 and the assessor valued the land at $75,000, then your total depreciable amount would be $325,000. It should be noted that when you sell a home where you also had a business, you need to pay a tax on the depreciation, even if you did not deduct it or if you are even in business anymore. The total amount will be based on your return and the tax bracket based on your income for the given year. Accordingly, it is good practice to deduct your home when you can to get the benefit of value that will eventually be taxed. Once you have identified a depreciable item, you will need to determine how you can expense it. The most basic way to determine how much you can expense in a given year is called straight line depreciation, though there are some other methods your tax professional may use. In this calculation, you take the total cost of the item and divide it by the total number of years that the IRS says is the life of the item. Some common useful life values from the IRS include office furniture, fixtures, and equipment, 7 years, automobiles, 5 years, land improvements, 15 years, a house or building used in part or whole for business, 39 years. For example, a land improvement such as a new driveway is considered by the IRS to have a 15-year life. So as you can see here, if you paid $15,000 for the new driveway, you could deduct $1,000 a year in depreciation for it, $15,000 divided by 15. There are some other ways to calculate depreciation, but many of them aren't relevant since you can often expense your asset in 1 year through 3 special rules. There are 3 special rules for depreciation that can help you deduct your depreciation faster. 1. There is Section 179 depreciation, which is allowable for tangible personal property such as office equipment, furniture, vehicles, and most other assets that are not buildings or improvements to your building, including a home used for business. There is one catch, however. The item needs to be used for your business 50% or more of the time. If you are a family childcare provider who wants to use this for an improvement to your home, you will need a time-space calculation that shows 50% or greater business use. For a vehicle, such as a van for transporting children, you will need to show 50% or greater use based on the total miles driven for a year. 2. The second special rule is known as bonus depreciation, which allows you to deduct 100% of certain assets in 1 year without an upper limit on the total amount you can deduct. To qualify for bonus depreciation, the item needs to have a useful life of 20 years or less, so it doesn't apply to your home, and be used for business 50% or more of the time. The second part is an important one for family childcare providers, since an expense, such as driveway paving, that meets the criteria of having a useful life of fewer than 20 years may not qualify if the provider's time-space percentage is less than 50%. One exception, similar to Section 179 depreciation, is that there are special rules for vehicles. For vehicles under 6,000 pounds, you can expense $19,200. For vehicles over 6,000 pounds but less than 14,000 pounds, they do not have a limit. Just like Section 179 depreciation, you need to use the vehicle at least 50% of the time based on the total miles driven, and the amount of depreciation must be adjusted by the business use. Bonus depreciation will continue to be 100% through the end of 2022. In following years, the percentage of depreciation allowed will decrease, starting in 2023 when you will be limited to 80% of the value, until it ends completely in December 2026. 3. The third special rule is known as safe harbor for small taxpayers. This rule comes out of the IRS tangible property regulations and allows providers to deduct repairs or improvements to the business location that are the lesser of $10,000 or 2% of the unadjusted basis. That is, the value of the property less the value of the land. For example, let's say you had a child care center that was worth $350,000 and the land is worth $50,000. The unadjusted basis would be $300,000. 2% of the unadjusted basis would be $6,000. So an improvement, like adding an awning, that was $5,500 could be deducted in 1 year. For family childcare providers, you would need to include the time-space calculation. With all 3 of these rules, it is important to note that the state limitations can vary, so depreciation as described above, may only apply to your federal tax return. Before we wrap, let's put everything together and look at how you might think through the process of determining if a purchase is subject to depreciation. As we just learned, you're going to start by asking yourself if the item is ordinary and necessary for your business. If you answer no, you don't need to proceed any further, as the purchase would not be considered a valid business expense. If you do answer yes to this question, you will then ask yourself if the life of the item is more than 1 year. If not, there is no need to depreciate. You just report it as a regular expense. If the life of the item is more than 1 year, you then want to ask yourself if the asset is worth more than $2,500. If it isn't, we again do not need to depreciate the item and can treat it as a regular expense. If it is and is not a repair, you would then determine what kind of expense it was. If it is office equipment, personal property, or any kind of land improvement, you would depreciate the item in 1 year using the bonus or special 179 depreciation circumstances. If the item is your home or building itself, you would depreciate it over 30 years. Home providers will need to use the time-space calculation in this instance. Lastly, if the expense is for a facility improvement such as a renovated kitchen, you will first need to determine if the cost is less than $10,000. If it is not, you depreciate the item using IRS Form 4562. If it is less than $10,000, you depreciate the improvement as a small business safe harbor expense. It is critical to have clear records of your purchases for the depreciation. These records should include what you purchased, when, the total cost, and any indication of the amount of business use. For example, was it 100% for business or a mix of business and personal use? It is also important to keep records of your remaining depreciation so that your tax preparer knows to apply it to future years. More information on record keeping can be found at childcare.texas.gov. Thank you for joining me for this discussion about depreciation today. If you are interested in any other helpful resources, information, and guides, visit childcare.texas.gov to find these on various topics in both English and Spanish. There, you also can sign up and register for free one-on-one business coaching.